everyone for joining. It should be a good conversation. Really excited about the panelists that we've got here to talk through about how to plan for your burn and then also how to communicate that plan to your investors. Our goal is really to help people tactically think about, how do you prepare yourself for this new market dynamic that we're entering? Obviously, in our startup life, we've got cycles. There's bull markets and bear markets, and the market has softened, valuations have changed. It's become a little bit more difficult to raise capital, which obviously as founders and startups, we have to think about how do we adjust to that and manage burn, hiring, and just control those expenses as we grow. We'll dive into some of those topics, define some of those words too, what burn means. But first, I'm just going to introduce our panelists really quickly. First, we've got Nanxi Liu, who is the co-CEO and co-founder of Blaze, a platform that enables teams to build web applications and tools without writing code. She's previously CEO and co-founder of Inplug, a leading global digital display software, which was acquired by Spectrio. She's on the board of Car Parts and Car Lots and is a partner at X Factor Ventures, which is invested in 80 or so, female-founded startups. Also interesting as a producer, she's received an Emmy Award for an Amazon TV show, and she's a graduate of UC Berkeley. So thanks for joining us, Nanxi.
Thank you so much for having me.
And then our other panelist, Elizabeth Varley, has been, building businesses, advising companies, and mentoring entrepreneurs for the past 20 years. Most recently, she was the founder and CEO of TechHub, where she spent 11 years stoking the fire of London's tech ecosystem. She's been awarded Computer Weekly's UK Top 50 Top Influencers, Evening Standard Silicon 60, Vogue UK's Generation Tech, and Cosmopolitan's Fierce 40 Under 40. All right. Well, let's kind of jump into the topic. I think first the attendees around what we mean when we talk about burn, expenses, and runway. And so just from a very high level, and I know working with startups for so long, we're probably pretty accustomed to using these words. And for those that might be first-time founders, those might be a little foreign. So burn specifically, and I'm sure, most of the attendees know this given that this is in the title, but burn is really around the net losses that we might have. I don't know, Nanxi, Elizabeth, if there's, I guess starting with you, Elizabeth, you've been advising companies for quite a while. As companies think about burn, how do you conceptualize that or explain that to founders?
I think it's very much, I think that the name, the word is very evocative. It's how much are you just burning through to keep the company going? I think it's how can you stop things from burning as much or have to stick some more money on the fire? I think I think people are really acutely aware of.
Yeah. And I also think, sometimes trying to give an example of this too, a lot of startups will raise money. Not every startup will raise money, and you raise, say $1 million, and you're going to have more expenses than revenue, as you're kind of saying, and you burn through that to, so to speak, and that decreases over time. And the expenses are obviously your spend. What are you spending on? And then runway. It's been interesting to try to explain this, but the runway is really just the amount of time you have before that's all burnt down and before you maybe come to the end of the road. Hopefully your company gets liftoff and either getting to profitability or other milestones that might help you raise more funds for your company. And Nanxi, not sure if you'd add any other context or other illustrations that you've used around burn, expenses, or runway.
Yeah, I mean, for burn, I think you guys described it pretty well. It's really, what do you need each month in cash to cover all of your expenses? That's it. Do you have enough money in the bank to cover the expenses? And so for a lot of companies right now, the best situation to be in is not to have burn, that you actually, you have positive cash flows. So, it's not just that you only have, that there's always burn. No, there's, many companies where they're not burning any cash. And so I also like to think about it on that there's an alternative to that. And then certainly Runway, it's kind of the same thing, which is how much cash do you have to continue operating? And there is such thing as, you have infinite runway based of cash you're generating.
Yeah, that's great. Yeah, and a good point that at some point your business, regardless of how much you've raised today, at some point you're going to have to transition to profitability. And it's a dangerous thing to continue to live on other people's financing. Just a real quick call out. So the Q&A should be available to everyone who's attending, and so if you've got questions, feel free to jump in the Q&A and ask questions of our panelists, and we'll do our best to make sure we're answering those things. Awesome. Well, going into Runway and talking about burn, as we kind of talk about, Elizabeth, you explained it well, which is how you're going to be spending those things down. How long does it take? On the Runway side, how do you guide entrepreneurs around how much runway they should raise, or is there a way they should be thinking about a period of time in which they should have funding to support the burn that they've got in their business?
The rule of thumb I tend to go with, I was talking about this with someone just the other day, is before A, raise every 12 months, after A, raise every 18 months. But of course, that really depends on what you're expecting to achieve in that amount of time. And I think you really almost always need to be keeping an eye to the next raise, starting to have those conversations with the investors that would be in your target group much earlier, create those relationships, ideally, so that you're not just going in completely cold when you're doing your next raise. But I think people should be expecting to probably raise a little bit sooner, particularly because it's going to take a little bit longer at the moment. I think we're seeing a correction from the last couple of years, and it's just going to take that bit longer to get the raise done at the moment. And so it's important to make sure you're getting a bit earlier.
Yeah, very helpful. Nanxi, as you've run your companies, have you, kind of used those same rule of thumbs, 12 months, early on, and then 18 months over time? And are you changing that, as Elizabeth said, to kind of extend out even further?
So right now, I think there's a lot of uncertainty. And so I would start immediately adding an additional 3 months before, when you plan to raise money before, to just get that process started, and to be thoughtful that the conversations that you have with investors are going to have a very different feel and dynamic. And the kind of questions they're going to ask you is going to be very direct around cash flow and understanding your current cash run rate, understanding what time horizon you have with the existing cash and how much you want to raise in the future. I certainly know for a lot of my existing investors, they ask their portfolio companies to send them monthly updates on what their cash run rate is. And that's something that didn't happen before. I think back, 4 or 5 years ago, that's not something VCs really expected, but now it's that they want to have a monthly update, and that's part of their reporting to their LPs. Their LPs are demanding this, and so with that, it's much more preparation around your financial metrics. And then I also think, for raising capital right now, it is, if you can raise it right now, it's sort of like, okay, take advantage of being in a position where you can do that, and just be in a much more cautious approach.
Yeah, I was having a conversation about exactly that just the other day, that some investors are seeing people doing small raises, saying, look, I'm going to keep it on the same valuation as last year, because we want to get money in now to make sure that we're secure for this coming period. And so I think it's really good to be flexible about things like that, because having more runway now that's more secure might put you in a better position. Look at changing terms.
And one thing I'll also say to this is we hear it, all the time, but I do really want to emphasize the best time to raise money is when you are not desperate for money, because whenever you're fundraising, the investors are going to say, okay, how much money do you have in the bank? If it's like, oh, I've got 1 month left, well, you're going to have the worst terms possible because the investor will probably push to ask for a lot of things and a lower valuation than you would have going into a conversation saying, I'm actually good for the next 12 months, but I'm doing it right now because I want to preempt what might happen in the market. And I want to say this is a really nice opportunity for companies that potentially could break even or become cash flow positive to actually do that now. And I share that from personal experience. At my last company, Implug, we actually became one of the most profitable companies in our industry. And it was not intentional. In fact, we became cash flow positive 3 years in because it was forced on us, which is that, okay, we raised a bunch of angel funding, and to raise that bigger round, it was like, I don't think we could do it. So we forced ourselves to be cash flow positive and to fix a lot of operations to make it such that we didn't need as high of a headcount. And it was a total game changer for us, because then we were actually able to have basically that forever runway I was talking to you, and using our own cash flows to generate our growth. And so it can be a very great time, I guess, for these companies to just force themselves to being cash flow positive.
Yeah, I always think the best kind of funding is revenue, if you can manage it.
Absolutely. Yeah, I think most of the time that you raise capital, and apologies, I was trying to fix something as we were getting started, so I didn't really introduce myself. So my background, just really quick, I helped run our lending practice at Mercury. In the past, I was a lender at FCB. I've worked with, hundreds of different companies across, from pre-product, pre-revenue to 100 million. Then I've been CFO twice, and so I've kind of gone through operating and managing these things. And the runway when you raise capital, whether we're talking about trying to get profitable, obviously most companies can't get the profitability off their first round of funding. Nanxi, I'm sure the angel round that you did was probably not 100 million to start, and so you've got to get some funding, and then companies raise money over time. Every single time you raise money, you really should be finding your pathway to profitability, whether that's your burn goes from 100K to 50K, you should be making incremental benefits. And by that, if your sales are starting to go, it's trying to showcase that your company can predictably or consistently generate revenue, and your sales reps can become accretive over time that can lead your company to profitability. I'm curious, historically, we've taken, companies have taken a more conservative approach. In the market the last couple of years, it's been a lot easier to raise capital. Now that's ratcheting back. I think for some founders, it's very confusing why investors were willing to invest in a company at 30 million valuation before it had revenue, and now that's changing. I'm curious, Elizabeth, Nanxi, why is that? Why are investors changing or becoming a little bit tighter on investing into these companies, or demanding more proof points or more revenue stage companies?
Yeah, I would say a couple of different things happened in the market. One, for investors like VCs, I categorize them in different groups. So you have the VCs. The VCs, they're representing their LPs. And so if their LPs are knocking on their door saying, hey, valuations are really crazy and IPOs are not happening right now, or they're happening, it's really systemic. And so if the later stage companies right now, if they wanted to IPO and they're going to not get a great price in that round, so then it's like, okay, that previous round is the valuation is going to be depreciated. And then you go, and then it goes all the way to the early stage, because you kind of work yourself backwards. So if the public markets right now are not good, and everything is down, then that impacts how investors are thinking about the returns if they IPO. So like the round before, maybe it's the Series D. So if you're thinking about the Series D valuation, then you go to C, B, A, and then seed round. So I think it really is just this macro environment that is changing the dynamics. Now, that being said, I think that investors still are writing checks to companies that have really strong financials, strong metrics, strong founding team, and a strong product value proposition. And so I think only companies, hopefully, that are worried are the ones that don't have product or haven't found that product market fit. I think that's when they might be more impacted than the ones that have shown really great traction. So again, I think it's the market's actually adjusting and correcting itself in maybe a positive way for a lot of companies, so that there's not so much noise now.
Yeah, I would agree with that. There is money around. It's important to not set your expectations that it's the same as last year. There was a lot of competition last year. So when everything's moving so quickly, investors have to say yes and get in quickly if they see deals that they really want. So I think with that, just sort of that kind of market correction, Nanxi, that you were talking about, we're seeing everybody just taking a bit more time, which means investors have that time to make the decision and not have to jump in on terms that are a bit higher than they would otherwise like. So I think it's really important for founders when you're going out to the market for investment at the moment is to be realistic about your valuation and your cap. If you revise it during the process, if you come back to someone that you've spoken to who's thought your valuation was too high, then if you have to come back and say, oh, actually, no, we've lowered it now, it loses you some credibility at that stage. So I think it's really important to be really clear about how much money you need and valuation in the current market to get that yes.
Yeah, it's super helpful. I think just pulling on something you said, Nanxi, about maybe a focus on in a lot of ways. I think some of the entrepreneurs are feeling the heat. The market has shifted a little bit to focus on some of those things or having a higher expectation. I would say generally, having gone through this a few times in the startup ecosystem, that's generally good for all of us. Where more stable companies are going to be built. Founders are maybe focusing on the right things and spending on the right things, which I think is a net positive. You just get stronger businesses built out of it. I'm curious, as entrepreneurs are trying to manage the burn, obviously burn is an aggregation of all of your spend and all of your expenses. Where should founders be really prioritizing their spend? How should they be spending? Where is it where they should feel comfortable? Yes, this is an area as an entrepreneur, money for.
One of the things that I always focus on is, do you have the best possible team? And so I think talent, no matter what kind of environment, look, if you're hiring a lot of folks that aren't adding value, this is the time to just cut, right? But if you have really talented folks, I think it's always good to invest in retaining them and making sure that you actually communicate with your team what your cash situation is. If there are teammates that are worried and not knowing what the situation is, that might be distracting them. And so I would also communicate with the team, but overall, it is that retention of great talent, I think, is still a priority. And so that doesn't mean, I know there are places, there's a lot of hiring freezes, but I think hiring freeze like in general, but I doubt that these CEOs are saying, okay, if we find somebody who's absolutely amazing, we're not going to hire them. No, I think smart companies will still right now, if there's some great talent out there, they'll still invest in finding those great folks to join the team. And then outside of that, I think it's if you have unit economics of your product or service where it works and a certain marketing spend is going to give great ROI, I would still invest in that. But I think a lot of companies might not be experimenting so much and throwing money into places they're not sure if it's going to work or not. But if there are places with marketing spend where there's a positive ROI and predictable ROI, then I think that's still a very good place to spend money.
you made such a good point about communicating to your team. I think it's, with everybody really, with founders particularly, drilling down into what's going on in the company. I was chatting to a product lead the other day who was saying, my CEO is making different decisions and changing things, and our processes are changing. And I don't know what the ultimate goal of this is. I don't know if it's stress from investors, if it's something else. And so that can ending up with people in your team not feeling very happy, feeling micromanaged if you're really focusing on costs and ROI and that sort of thing. And so what you were saying about making sure that your team knows.
Yeah, it's always difficult. I mean, there's a balance of being thrifty and being careful with your spend. And the way you communicate or maybe manage that with your company, you can maybe make people feel like it's more urgent or more dire or more dangerous of a situation for the company. And that transparency, I think, is quite helpful. Are there tools that you all have used or recommend for founders on how they can get a better understanding of how much runway they really do have left, or what their burn is?
I mean, for us, we track all financial metrics. We use QuickBooks, for example. And so we just make sure you have great bookkeepers, maybe a great, whether you're hiring, external CFOs or you have somebody in-house or, consultants, make sure that they're top-notch and have the correct numbers and are giving you details and insights into exactly what's happening with your cash position. And so I think that's critical. And so for me, because I have a finance background, for me, it was, I actually put together our company's financial projections and our financial model. So I'm very aware of it. But for other CEOs, you might have somebody else be building that model for you, but you have to understand it intricately. And hopefully you have a CFO or external CFO or somebody that is sending you monthly at the end of the month, basically, all right, here's the cash position, here's the P&L, et cetera. Here's what the balance sheet looks like. And if you don't, I feel like this is a time where you have to know. And if you are running short on cash, maybe you only have a few months, I would almost have it as weekly, if not daily, what's our cash burn, and going line by line, what are the expenses? And so I think you have to make sure you have a place where all of that data is captured, and you can anytime just go in and check and just see past financial performance and what the projected future financials look like.
I think the most senior financial person that you have, whether they're internal or external, ideally you will get the most value, particularly at this kind of time, if there's someone who is also strategic, not just about tracking numbers is really important, but particularly if you don't have a finance background, having someone who really understands your business and what your goals are and what your aims are and what you want to achieve over time, that's really, really important. It makes a massive difference having someone who is really strategic. But also when you're coming to managing costs, you really have to go through it line by line and really understand everywhere that you can trim costs out, whether you're looking at credit facilities that you might have that cost the company, but you're not using them. If you're in a good cash position, you can end up spending a lot of money on things like that you're not actually using. And one of the other things when we think about this kind of environment is, what do you do about the revenues coming in, analyzing your customers, looking at your pricing, going through that kind of exercise is really important at the moment. A lot of companies underprice their products. And so I think that's really important to do a competitor analysis, see what else is out there, who's charging what, how much you feel you can push your pricing and offer discounts to bulk buyers, but also be analyzing your customers. Who are the unprofitable ones? call them if you've got big customers that you can talk to on the phone. Call them and find out what's the state of their business, what are their spending plans with you. If they're unprofitable, can you move them to profitable? If they're taking a lot of support time, is that still profitable for you, depending on how much their spend is? I think it's.
Yeah, it's a really good point. I as a CFO, we used to, one of the first things that I did joining a company that it has been able to raise money for a couple of years. And so it started a bootstrap company, pretty thin, profits. What was really important, both of you guys hit this, which is having visibility into your numbers. I think it's good to have a good advisor that can help you understand and interpret those numbers. But at some point, you as a founder really need to understand that on your own. And you have to have the visibility into it, not just every month, one time a month, but daily, weekly. And so whatever tools give that to you, and Nanxi, I'm the same way you are. I build all of my models myself, spreadsheets and things that I can manipulate on my own. But there are other tools out there, dashboards and things that may take a little bit of an investment to get set up, whether using Google Sheets that connects to your Salesforce or whatever it might be. But getting that visibility, I think, is important. And I do think, doing the deep dives you guys talked about, maybe that's not every day and probably not every week, but maybe once a month or once a quarter, really dive in line by line, understand and question, where you're spending, I think is important. I'm curious, there's a question in Q&A. I think this is an interesting question, which is, what should VC be really used for? Like, when should you feel confident raising that capital? Obviously, if you're raising money, you're using that to subsidize burn, and there's going to be revenue that comes in that helps support burn, but maybe that revenue doesn't cover all of VC. Is revenue offsetting headcount costs? Do you think about VC offsetting headcount costs, or like, what is the real use of raising additional capital in your company?
So
sorry, go on, Nanxi.
Oh, no, Elizabeth, you go.
I always see it as the opportunity for growth as much as possible. If you have been able to achieve things and you want to do more of those things, that's a really good way of looking at what the investment funding is going to do for you. Do you need more people so that you can do more of what you're doing? Do you have a feature that your customers have all been asking for and really are committed to if you're able to make it available to them? Those sorts of things are really demonstrable, I think, to investors. You're saying, here are the things that we've been doing. And
I say, VC money is really only for a very small percent of companies out there that it would be appropriate for, and that it would make sense, or VCs would even consider funding. I think for VCs and there's lots of different ways to get capital. There's angel investors that you can get, friends and family. There's, traditional VC. There's, of course, venture debt. There's regular debt market. You can take out loans from a bank. There's grant funding. There are, again, lots of different places you can get funding, and VC only applies for a very particular kind of company, which is one that can demonstrate high growth, high scalability, and outsized returns for the VC firm. So if you're, for example, just like a standalone one restaurant, you're probably not going to be able to raise VC money, nor does it really make sense for you. But if you are a company that might, like in enterprise software, require a lot of upfront investment, but it's highly scalable, then you probably have higher likelihood of being able to successfully raise VC capital. And I'll say, for my last two companies, I didn't go VC, and they were fantastic outcomes. So one, the company, so Implug, we raised, basically a little over $2 million of just angel funding, friends and family. And then we became cash flow positive. We kept on growing. And when we sold the company, because we didn't take much VC dollars, VCs generally every single round you're giving away, call it 20 to 30% of the company. So you do a couple of rounds and you as the founder, you get diluted, and so do the early investors. Of course, you hope that the valuation is continuously growing such that it makes up for it. But at the end, when we sold the company, our angel investors, some of the early ones, they got a 250x return on their investment. Somebody who had invested 20K in our company got $5 million back. I mean, that wouldn't have happened, I think, and again, you have to assess, does my company make sense for VC dollars? And can I grow at a rate where those VC dollars make more sense than if I just reinvested my own cash flows into growing the business? And so VC dollar isn't always the answer, but it is if you can demonstrate that you're highly scalable and that you aren't going to just be diluted from, whatever.
Yeah, super good. Good context and advice there. And I think it all centers back on what you were talking about, Elizabeth, which is growth, right? Like they're investing in growth or the promise of growth. Maybe the growth doesn't happen next week, but the idea that you're investing or capturing an opportunity, maybe just breaking down just a few things for our audience. If you are investing in something that is going to grow and it's going to grow over a long period of time and you need funding to support that effort, but might not have immediate, return, VC does really well for that. Nanxi, you brought up debt. That's my background, is doing venture debt and building out our venture debt product here at Mercury. And those are really good for the shorter term needs, right? Like VC is really good for, I'm going to build this really intense product and it's going to have this great, massive reward at the end of it over a period of 5, 7, 10 years. That's really good for, I'm going to invest in something, maybe it's sales, something that's repeatable and will give me a faster ROI over 12 to maybe 24 months. And I think we've all kind of talked about the maybe using your own funding, so to speak, which is revenue. And that's a really good revenue source for things that are even shorter term than that. Maybe it's 3 months, maybe it's 2 months, and you're taking your own cash on your balance sheet, investing it and finding those returns. I'm curious though, obviously things don't always work out. If you're raising capital, raising debt, or, using your own revenue, how do you make the decision of, so we talked about in this certain situation, prioritize people, continue to invest in people. How do you make that decision that I'm really in a position that I can hire, or maybe I just keep my people, or maybe I have to think about layoffs? How do you think about, you're in a situation from a burn perspective that you need to start thinking about cutting confident and adding heads?
Yeah, I went through that. I'll share kind of my personal experience in 2015, where we basically were running out of runway because we were relying on outside investments to basically pay for expenses in our company. And it was like, okay, all right, so sure, we can, I can just go try and get, 100K, 200K just of angel dollars, but this is just not sustainable. We need to make some decisions. And so when it comes to, do we hire more talent? Do we let go of folks? It is, again, how do you optimize the operations of your company? And so one of the places we recognized is we had a lot of folks in technical support. We were, my last company was also enterprise SaaS, and it's a technical product. And we had a lot of folks. And so the number of technical support folks that we had at the time in 2015 was actually the same number we had when we sold the company. And we were, many magnitudes greater in revenue and profitability. And that's because at that moment in 2015, it was okay, we're going to cut technical support, but we're not going to lose the basically our business's value that we provide, because what we're going to do is we're going to replace it with automation. And so we put in this really robust knowledge base. It took some time. So there was definitely an increase of tickets that were not getting responded to as fast as we were when we had a lot more support folks. But what we did in that process is we built out a great knowledge base. We built in chatbots. We built in just easier, how-to articles, how-to videos, et cetera, invested in something where essentially essentially that resource hub was replacing, actual folks that we needed. And so I think when it comes to cutting folks, how we looked at it is, okay, are we going to be now permanently damaging the business and our value proposition? Or is it that we can make these cuts, but actually we're going to improve our operations so that we actually can lower the headcount, but still make sure that our...
That's super helpful. I feel like, was there anything that made you, because I do think like when we talk about growth and investing in the growth, sometimes, and especially over the last couple of years in a bad way, I think a lot of entrepreneurs or maybe companies have thought about growth, not just as revenue, but also headcount. Like, oh, I'm raising a bunch of money. Let's just grow and hire as many people as we possibly can. How did you make that decision that like the way that we were going to actually continue to sustain our growth was investing in process rather than investing in more people at desks?
Yeah,
was there specifically something?
Yeah, I always say, I feel like maybe leaders that don't know what they're doing will throw bodies to try to solve the problem. And that definitely is not the situation. Sometimes maybe it is, but oftentimes it's not. It's, I talk about making sure you have great talent, but that's ensuring that talent is providing value that a process is not going to fix, or that they're irreplaceable by a system, right? And so I always say, okay, do you actually see the solution? Is the solution hiring somebody? Are they going to solve it, or is changing the process? Maybe sometimes it's changing the culture, and that's going to shift it. And an example of the culture piece is, let's say that you're trying to hire more maybe QA folks because there's so many bugs. Every time developers are releasing something onto production for your product, there's all these bugs, so you have to hire more QA. Well, that's not really a solution. Maybe it's that the first time they write it, you have to build a culture in your engineering team where it's optimal. Maybe you have to make sure, the engineers that are going to be fixing are the ones that originally wrote it. I've seen in companies where it's one group of engineers are developing the original code and writing the new feature set, then it goes to QA, and then the maintenance goes to another set of engineers where the first engineers aren't being held accountable for some of the bugs that they're creating, right? And so it's ensuring you have, again, that involves process and also part of the culture, which is accountability and making sure that mistakes in an organization are minimized by ensuring that you...
Yeah, that's the hard stuff, though. I feel like trying to get that culture is really hard to instill. I also think like in some of these situations, and I've gone through this, and I'm sure you both have seen this, which is you're growing, you're seeing some success, and you're probably, people maybe have career aspirations to be managers, or they're seeing other companies hire at a really high pace. And maybe whether you're in a market, where you need to be conscious of cash, or maybe you've just, you can sometimes feel squeezed, and especially those people, and maybe it's the engineering org that is actually doing a really good job and growth is coming, and you're now telling them, I'm not going to hire more on your team. We want you to invest more on process and product and all those things. How do you manage that? And we talked, I guess I brought this up a little bit earlier too, but how do you manage that psychology or those feelings that like, are we unnecessarily lean, or like is the team and the entrepreneur being just way too tight around the wallet? How do you get the team on board and make sure that everyone feels excited you're leading or managing the finances?
Gosh, I think you really have to, one of the really important things is to understand what motivates the people in your team, especially the best performers in your team, because it might not be just around money. As you say, Jason, it might be they want to move into a managerial role. Is it that they're interested in a title bump more than they're interested in, X amount of money? I think it's really important to understand that, and to understand that people really care about career progression. I think as founders, it can be really easy for us to forget about that because we don't necessarily feel it because, our title doesn't really matter. Our career is built by us, so it doesn't matter in the same way. So I think it's important to understand what is important to others and to help them feel included in whatever is going on. If someone's interested in management, they need to be the right kind of person for management. And if that's their goal and you don't think that they're right for that kind of role, then you're going to have to let them go to somewhere else. You're not going to be able to give them the things that they need. And that can be surprisingly important. Even in lean times, people want to be able to reach for the things that are important to them.
I think part of it is also, going back to the communication piece again. It is making it really clear to the engineering team where it's no, we're not asking you to work more hours. Actually, it is like, let's fix the process so that it's actually easier. Everything should be easier. And so I think, again, it always comes from the leaders. And so whoever is that engineering leader, fortunately for our team at Blaze, my co-founder is our CTO and is the lead for our engineering team. And so he really sets the tone and the strength of the engineering team. So they see, and he has a very clear understanding of our cash flows, cash in, cash out. And so he understands, okay, why can't we hire more engineers? Well, he sees, the cash out, or when there are times where it's like, oh, we're bringing a lot of cash in. Okay, now I understand with our cash flows, we can go and, hire X number of folks in. And so having that transparency for the leaders, because ultimately how they respond to the environment and how they're, conducting their team meetings, is it that they're do they look like they don't know what they're talking about of why we're not hiring more engineers? And it's like, oh, I was just, told not to hire more folks. They're just like, hey, actually, I've been communicated with our cash situation, the cash in, cash out, and our cash out is greater than our cash in. So we have this burn. And so we have to, we're right now not going to, hire more engineers. But I'm not asking you guys to, work more hours. Let's actually make life easier for us by seeing where in the process we can, again, make life easier for everybody on the engineering team.
Optimizing, always a good solution.
Mm-hmm.
Yeah, absolutely. Going back to kind of raising capital and maybe the optimizing and focusing on growth, obviously, and this is not always the truth, but if you want to grow faster, typically you're investing heavier into the business, whether it's spending to find customers or buying and hiring more sales folks. Obviously, if you're on the path and you're raising money from VC, they want to see that you're growing quite quickly. But then obviously the market's getting tighter, maybe harder to raise capital. How do you balance that? VCs want you to grow at all costs and grow as fast as you possibly can, and maybe as a founder you're worried about access to capital, or maybe you only have 6 months of runway. How do you decide the trade-off between growth or profitability?
I always say the founders know the business the best. They don't, they should. And so always understanding the position of the VCs that you have involved and the relationship you have with the VC, such that you can communicate, hey, I understand you want us to grow, but here's why I don't want to do it. And so always having the open line of communication and sharing your thought process around it. Because if they're saying, hey, we want you to grow, keep reinvesting, and you're like, I don't feel comfortable with that, maybe they're seeing something you aren't, or you're seeing something that they're not. And so again, having that transparency and that communication is going to be critical. And of course, it also is about when you think maybe they're really optimistic about you being able to raise the next round of funding. Maybe they have some investors, future VCs in mind to join the next round that you don't know about. And so say, hey, all right, so you want us to really grow, but we've only got 6 months of runway left. Can you tell me, how you're thinking about, like, well, one, we should be raising money right now. How are you thinking about, if we are going at this burn rate, how are we going to sustain ourselves past the 6 months? And so being fully transparent and asking those questions that might seem like obvious questions to ask, but oftentimes I actually see people like with their VCs, they just don't really communicate. And so everybody has information that the other doesn't know about.
It's so important to have a good relationship. I mean, from the outset, that's a really good reason to look for particular investors that you feel like you resonate with, that they understand what you're trying to do with the company, that it's more than just the money, it's the contacts and the desire to help you go to the next level. That's not just their return. Obviously, that's the most important thing for them. But I think that some founders can see that investor-founder relationship as sort of more one way in terms of that sort of power dynamic. And as Nanxi, you were saying, it's got to be about those conversations. You should have a relationship. You're in this together. You're both helping each other succeed, and being able to say, well, how do you see this going? Why do you see it going that way? I need some help to understand this, or I'm getting nervous about my next round. Can you help me plan out the next raise now so that we're ready to go? It's not just, okay, we just have to deliver growth and look like we're always delivering growth all the time to keep them satisfied. This is a relationship, to remember that.
Yeah, absolutely. Couldn't agree more. And you really shouldn't feel like they're pushing for something that's unnatural to you. You really should feel aligned between the two parties. Maybe, going a little deeper on that, and I don't know if you guys have been involved in companies like this, but let's take pharma, or maybe something really highly technical in hardware, or maybe it's fintech, where you've got a lot of infrastructure you got to invest in. Maybe in pharma, you've got to get clinical trials, and you got to get those approved in order for you to actually generate revenue. And so it's really not an option to generate revenue in the first 2 years of a company's life. How did those entrepreneurs go around showing the promise of growth and ability to manage burn when there is no possibility to generate revenue on the top line?
I think you have to show that you really know what you're doing, like you really know your product area, your research area, and that you're bringing in experts and advisors to help you plan it out. I think expecting that you're going to know everything about that, and that an investor will say, oh, okay, that's fine, your assertions are good enough. I think demonstrating some independent advisors, looking at other businesses that have done not the same thing, obviously, because your product is unique and unrepeatable, but the trajectory of other businesses that are like yours, I think, is also really important to research, to understand, and to be able to communicate to investors, to show that you are following a path that has been trodden before and you can stones along that path.
I can totally understand the question related to it, because I've been involved in a couple of biotech companies, and specifically one where I served on the board of directors of a company called Kindred Bioscience. Last year, we were acquired for $440 million. And seeing that process, basically, I was on the board since day one of selling it to this other public company. And for the founder, he was such a great storyteller. And so for many, many years, we did not have a product out. It was so much R&D going through the regulatory process to get the product to where we needed to be in order to commercialize. And so there is a lot of investment, and you're right, there isn't going to be any cash flow coming in anytime soon. And so some of these pharmaceutical, biotech, a lot of it ends up being that you are just banking for that moonshot M&A deal to happen. And in order to do that, you have to constantly raise money. And it's not uncommon for, publicly traded biotech companies to not have any revenue and just constantly, raise more capital. And how are they able to do that? It's the storytelling. It's the future potential that the company can generate this return for the investor that comes in now. And so for founders that are in that kind of category where you're not going to have product or revenues coming in for a really long time, then you have to just be fantastic at demonstrating your R&D or product progress. And you just have to keep raising money. And in that situation, the money that you raise is going to be very much from VCs or, again, private dollars somewhere. For a lot of biotech, there is quite a number of grants out there. For a biotech company that I started, we funded 4 years of our company actually just through grants that we received from the government and from other institutions, because we were doing something that was really good for public health. And so we were able to get those grant dollars, which is amazing because you get money and you don't get diluted at all. And so that's pretty fantastic, and certainly a option for certain types of companies.
I think for founders who are coming from an R&D type background, if you're not commercial, if you don't have that ability to tell that kind of commercial story, it's really important to make sure that you're bringing people into your founding team who can do that. Exactly as you're saying, Nanxi, it's if you're only able to talk about the technology, about the science, and not weave that into a story,
Yeah, it's super important. It's so interesting how I think historically in startups, it's been all about operations and building, and storytelling has truly become a competitive advantage for most companies. And to your point, I've met a lot of founders that's basically all they do. They're great fundraisers, they're great storytellers, maybe they're really good culturally in leading a team, but that is the big focus for them. And in some companies, you need that. I'd also just maybe add too, with some of these highly technical companies, revenue. Your investors, again, your revenue in the early days most likely is not going to offset all of your burn. And so revenue becomes this scorecard, a way to a metric that you can use to gauge how you compare against another company and what your promise of growth is. And I've got to imagine, Nanxi, in that biotech company, there's probably some metrics that the founder was really consistently pulling on. And maybe it wasn't revenue, maybe it wasn't even an indicator to customers. It was maybe the productivity of the team or whatever else it might be. And in order to help your storytelling, finding your benchmarks, how do you compare and how can you suggest that you're going to be the one that wins is really helpful. Going back to burn, and I know we're running out of time here, so I'm going to hit a couple of questions before we jump, and appreciate everyone joining. We talked about burn, and that's all of your, kind of losses and how much money your company is losing on a monthly basis. And we talk about Runway. We've talked about some benchmarks, 18 months and maybe longer than 18 months at this point. At what point should you start panicking? Nanxi, you said something about 3 months, make sure you've got a buffer of 3 months. Is it, hey, I haven't raised any money, I really need to start, looking at layoffs or looking at other possibilities to extend out my runway? At what point do you feel uncomfortable and need to become more urgent about your fundraising? Is that 3 months, 6 months? Is there metrics you look at? How do you manage that?
And I'll correct, not 3 months of money in the bank. I mean, you need at least 3 months extra now in this current environment before
the fundraise. Got it.
Originally planned. So adding an additional 3 months. So just want to make that clear. I would say every company right now should think about unit economics. So even, I think companies should really worry if they're burning a ton of cash and their unit economics aren't showing profitability. And what I mean by that is, let's say you are selling a bottle of water. You're selling it for $1, but your cost of goods sold on that is $3. And so I would really be concerned in that. So I would very much, for every company right now, focus on the unit economics and can I tell that stories? Because if I was a smart investor, I'd immediately go and dive into that piece, which of course you can say, oh, right now we're not at scale. And so the unit economics don't really work out, but trying to make sure you get as much as possible to the unit economics. I would, for every company, regardless of sort of the situation, I would want to make sure that I see a clear way to make it such that I have a clear vision of how I'm going to get to profitability. As you mentioned earlier, Jason, eventually companies need to reach that. And so at least understanding the path to get there, or again, just.
Yeah, super helpful. I think the additional 3 months too, historically, a lot of people have been starting their fundraisers at 6 months of cash left. And I think that 9 months, adding that on is probably a little bit, more comfortable, to your point. And so I would start doing that. Okay, last big question, and this may have us go over, and I apologize. I'm just curious, we're talking about managing burn, we're talking about managing runway. I think a lot of the reason why this is so on our minds is because the landscape, it's harder to raise, VCs are saying no a lot more, maybe a little bit more absent. And that's starting to, and the reason why is because there's in the news economic turmoil, and there's going to be a crash, or we're entering a recession. How do you guys think about this in current environment? Is this really that bad for entrepreneurs? Is it going to get worse? Where are we at in the situation in your opinion?
I think we've seen corrections in the market. We certainly here in the UK, we're seeing cost of living increases, which is affecting a lot of people and can affect the money that you have going out on your people cost. But the most important thing really is to be really clear about your goals and how you're going to achieve them, and just keep doing that. I think it's very easy to become too conscious about the broader economic environment when day to day what's happening for your business, as long as you have an appropriate plan and you're doing things like we've discussed about making sure you're starting your raise process a bit earlier. I think it's, the best time to do anything is always now. And so it's important to keep that in mind and be sensible, but not, I guess, get too in your head about possible terrible things. We've just been going through a couple of years of pandemic, and that has been a completely unexpected, huge global phenomenon. And we still have opportunities. There are still many, many opportunities. And I think it's important not to feel like that's not there, or the environment isn't.
And I would just say, in environments like this, I use it as a way to strengthen our culture and to encourage our team to say, hey, this is an opportunity where we have funding. We have a top-notch team. This is a time where everybody else is distracted by needing to raise money. And so we can get ahead of our competitors in this time. And this is what I literally shared at our last team meeting. Everyone right now is either freaking out or taking vacation over the summer. So this is our time to get ahead and, again, build our platform and stand out against any of our competitors and prove to customers we're heads down, working hard, making sure we give folks the best platform for building no-code tools. And then when it comes to the correction, is it overcorrection? I think I saw a Q&A in there that was saying, is this a overreaction? I don't think so. I actually think there's a correction because I'm a founder and I'm also an investor, and so the kind of valuations I was seeing was insane. It was like the highest I had ever really seen it in my time that I've been, I guess, in the working world. And so, yeah, I think it needed to have this correction. And I think the companies that it's going to hurt are the ones that had really over the top valuations in the past few years. But I think the ones that are, heads down, putting out great metrics, they're going to be fine, just as they would, I feel like, in any kind of environment. And so I think it's an opportunity to separate the really great companies from the ones that weren't that great or had just way inflated valuations. But at the end of the day, for my team, we don't really think about predicting what's going to happen in the economy. We're just going to focus on what we control, which is making a great product, making sure our customers are happy, and using this time for us to be focused once are distracted.
Yeah, great point. And I think you hear this a lot. Great companies always have access to capital, or great entrepreneurs always have, ability to adjust and change, whether it's not raising capital and going cash flow positive, or, and I think that's hard for a lot of founders to hear, though, because it means that maybe they have to be self-aware of where their business is or the opportunity that's in front of them. And in a lot of ways that can be healthy for our ecosystem. I really appreciate, all of your thoughts and guidance and advice from the experience that you've got. Is there anything else you want to share on Burn and the current ecosystem, or something that maybe entrepreneurs can leave here to feel positive about their business or the landscape we're entering? Any last words?
My last word is, Elizabeth, I loved getting to meet you. Thank you so much, Jason, for your great questions. And then with Burn, you don't have to be burning money. Like, you can make your company such that it isn't burning money. That's what I have to say about Burn.
Absolutely. Yeah, great to have this chat with you as well. And some really good questions from the chat and from you, Jason. And I think it's you want this product to be out in the world. You want this business to succeed. The most important factor in that is you as the founder. And great founders can always make great businesses. Always.
Awesome. Well, thank you, Elizabeth and Nanxi. Appreciate everyone joining.